Joining us now is John Petrides, Managing Director and Portfolio Manager at Point View Wealth Management. John, it's good to have you with us. We want to start with China. How big of a threat now with President Trump's increased rhetoric are we looking at for this China trade war and potentially $300 billion more dollars worth of goods taxed?
Well, thanks for having me on. And first, it's a tough comp following Tim flashing the triceps on the last Peloton segment. But in all seriousness, increased tariffs to $300 billion, I think really would be a disaster. You're hearing a lot more CEOs who are getting nervous about the overall impact on the global economy, particularly someone like Jamie Dimon coming out and saying, the longer this prolongs, the worse it is for all involved. So, you can't trade the headline, you can't trade the tweet, because as much as he said, well, I could increase to 300 billion, at the same time he said, well, it looks like we're making some progress, or it's better off for the Chinese and the Mexicans they need to come to some resolution. So it's a tricky situation. Obviously, you're seeing how the markets are reacting. The bond market has had just a tremendous year. Investors have flocked to safety in the form of bonds, and plus with the Fed staying on the sideline, yield-oriented securities have rallied. I think your point of how weak tech has been over the last couple of days is quite interesting, because tech is such a dominant sector in the S&P 500, and the market has proven quite resilient. Other sectors are rallying in the face of continued, I think, headline pressure. So, I think it's by and large been a good start to the month of June, despite what the upcoming headwinds could be.
I mean, given this threat by Trump of additional tariffs, and then the amount going up from 10% to 25% last month, China retaliating, restrictions on Huawei. In terms of the developments on this escalating trade war, what thus far has been the most worrisome development for investors, do you think, John?
Well, I think, anyone who thinks that tariffs are going away needs to, just temper those emotions. Under the current presidency, and President Xi has power essentially in perpetuity. So tariffs will never go away. That's just the reality everyone has to come to. What we do hope is that both sides take a step back. The dollar amounts maybe get reduced, the percentage of taxes get reduced, certain industries are taken off the list. That's the best outcome, I think, that investors can hope for, and that really the global economy can hope for. But this is never going away. I think the more worrisome issue, particularly that you mentioned Huawei, is that, are we entering, Cold War 2.0 with the Chinese, where the U.S. and the Chinese both need each other, obviously, economically as trading partners and being the two largest economies in the world. But do we continue to have this, tension without military conflict? So, that to me is a lingering longer-term concern here.
Interesting, John. Look, some have said that neither the trade war nor the tough rhetoric on Huawei are fully priced into this market right now, which has just been on a tear the past 3 days, despite even more tariff threats looming. Are you of the notion that we could see a significant drop from here because it's not priced in, that we could anticipate more tariffs down the road?
Well, I mean, we saw a big sell-off in the month of May. I mean, I think the S&P 500 was, down 8% or so for the month. So it's not uncommon for the stock market to fall between 5 to 7% or 5 to 10% from peak to trough during the course of any calendar year. So I would just expect that volatility will remain. We have really been in a tight trading range, or a trading range, since really February of 2018, when the Fed had to start raising interest rates because the wage data has popped. We've been stuck between about 2,400 and 2,900 on the S&P 500 because there are so many cross currents going on. But if we can get, with the Fed on the sidelines now and companies doing the best they can to continue to grow earnings off of tough year-over-year comparisons, if we get some resolution or some easement on the language between the U.S. and the Chinese, some sort of agreement, then I think stocks are poised to rally a lot harder. If not, then we're going to be stuck in this range and just hope that the underlying economic data can be okay. It's not going to rally strongly, the economic data. We hope that it doesn't start flashing more signs of recession and we sort of stay range bound.
John, given that you brought up the Fed, Jerome Powell has been emphasizing his dovish stance, his patient, data-driven approach for some time now, but what is incremental now in terms of whether it's economic data or escalation in these trade tensions that now make him maybe more open to potentially cutting rates this year?
So in 2018, we're 1 year into trade tariffs sort of marinating, and we've seen the impact that it's had on the Chinese economy. The Chinese economy had a very rough 2018. We've seen now the reverberations to the global economy as economic data is slowing. Well, during that time, the Fed was raising rates 4 times in 2018. So as tariffs were slowing the global economy, the Fed was essentially pouring kerosene on the fire. And now you've gotten through the year, and the Fed has really taken a more dovish approach. I think they realized that inflationary pressures, which they were trying to cut off really over the past 10 years after going unprecedented monetary policy and trying to stimulate the economy out of the Great Recession, they may have overshot in terms of raising interest rates, meaning inflation just really isn't that much of an issue as the Fed was fearing, and they've reached a certain level where they feel inflationary pressures are contained. So, the fact that the Fed's language has become significantly more dovish to start the year, I think is a good sign for stocks, because it shows that the Fed is listening, the Fed is responding to slower economic data, and the Fed is here to support the system that, if the economic data turns, the Fed will pivot as well.
All right, John Petrides, we got to leave it there. I wish we had more time with you. John's the Managing Director and Portfolio Manager at Point View Wealth Management. Thanks again for joining us.
Yeah, thanks for having me on.